Okay, here's our Chapter 15 summary. This is investments. And it's not a tough chapter, but I will tell you the thing I think that confuses people is that we're talking about debt and equity and securities, but in the previous two chapters, we were the one that was issuing the equity or issuing the debt. And in this case, we're buying them. So we are the investor in this time. And so when even though I'm talking about debt and equity, they're all assets to us now, okay? So types of investments, we have debt investments, and again, it's debt to the person who issued it, but to us, it's an asset. So these would be the bonds. And so in the previous chapter, we were issuing bonds, we were borrowing money. Now we're on the other end of that. We're the person that bought the bond and is receiving the interest and all that kind of thing. And the other type we have are equity, which are stocks. And both of these are called securities. So when we buy it, it's an asset and it's called a security. We also have short-term investments. These are things that we plan to convert to cash within a year. And we have long-term investments that we're going to hold for more than a year. So it might be a bond that we're holding the whole time, or it might be something that we're just going to hold on to for a little bit. Why do companies invest in these securities, in these debt and equity securities? Mostly for the same reason that people do, to earn income. So I can earn interest income on a bond or dividend income on a stock. Or maybe I'm not really that interested in the dividend or the interest, but I'm trying to make a gain on the sale, so I buy it when the price is low and then sell it when it gets higher and make a profit on the sale. So those are the same reasons individuals invest in stocks and bonds, and it's the same for a company. Sometimes a company might have one other reason, and I'll call that C, and that is to gain control of a company. So if I have enough of its stock, then I have a say in what they do. So those would be the reasons that we invest in stocks and bonds. We have 5 classifications of investments, of securities. Classifications. 1 are trading securities. So these can be either debt or equity investments. If it's equity, that means we own less than 20% of the stock in that company. If we own more than 20%, it can't be a trading security. We are planning to sell these within, at most, a few months. And these will be listed as current assets because they're going to be converted very soon. So current assets. A second type would be held to maturity. These only apply to debt securities because stock doesn't have a maturity date, right? And so these are ones that I'm going to hold to the long term. So for the most part, they go in long-term assets. However, once it's going to mature within a year, it would move to current assets. But for the most part, it sits in long-term, and then once we get to within a year of maturity, we would move it over to current assets. So it could show up in either one on your balance sheet. 3, available for sale. Available for sale. Held to maturity, I usually write HTM, and available for sale, I usually write available for sale. No, available for sale. These can be either debt or equity, and they can be either short or long term. And these are ones where I might sell it soon, but I might hold on to it for longer. So with the trading, you have to get rid of it within a few months. But if you're not really sure, it could go into here. And these, it'll pretty much in the problem have to tell you it's available for sale and it's short term, because otherwise you wouldn't know. Again, if it's equity, it has to be less than 20%. So for the fourth one is significant interest. This would be equity where I own between 20 and 50% of that company's outstanding stock. And the fifth one would be controlling interest, where I own more than 50% of that company's outstanding stock. So I have controlling interest. And so the category that it's in depends on how some of our journal entries go. So you have to know that up front, which category it is. Okay, so this is a chart out of your book which sums up what the stuff I just said, but in a little bit neater form, so you can use that one if you want. How do we account for this? So let's do debt securities first. When I purchase a bond, I am going to debit, it'll say like short-term investments trading. That's the name of the account, that's the name of the asset, or it could be like long-term investments held to maturity. So the name of the account will always be short-term investments or long-term investments, and then the type. So I would debit that asset and I would credit cash because I'm buying it this time, so the cash is going out. So that's what it looks like when I purchase the bond. When I receive an interest payment, so we figured out how to calculate what the interest payment is in the last chapter, and so the process is exactly the same, except this time I'm on the receiving end. So I debit cash because I'm the one that's getting the cash, and I credit interest revenue. And it's the same thing. You would take the principal times the interest rate times the number of months. If it's semi-annual payments, 6 months, so you cut it in half, just like we did in the last one. And then the third type of thing we have is disposition, when you dispose of it. So this would be when you sell it or when it matures. So with the disposition, it's just the opposite of the purchase. So I'm getting cash because they're paying me back now, and then I debit that asset, that short-term investment trading, or long-term investment held to maturity, or whatever the category is. So the name can vary a little bit, but the process and the journal entries are the same. Just the name of the asset has to describe what type of investment that is, what type of asset. So here's sorry, a little example here. This is in the demo problems. On January 1st, Worden's Restaurant decides to invest in Lake Turner bonds. They mature on December 31st, 2030. They pay interest twice a year at 5%. The market rate of interest was 5%, so they sold for face value, and they plan to hold them. So it's going to be held to maturity, right? Oh, I'm going to need that space for something else. So they plan to hold it all the way up until the maturity date. So the two journal entry, we'll just go ahead and answer number 2, held to maturity. Number 1, what journal entries do we have? So when we purchase the bond, we'll debit the asset, long-term investments held to maturity, $150,000, and we credit cash because that's how much we paid, $150,000. And then when we receive our first interest payment on June 30th, so this would be, let's see, January 1. Interest payment on June 30th, we'll debit cash because we're going to get cash, and we'll credit interest revenue. How much are we going to get? It's the face value, $150,000 times 5%. And then we'll have to split that in half because it's a semi-annual payment. So that'll be $37.50. So we'll debit cash $37.50, credit interest revenue for $37.50, and then when they get an interest payment on the 31st, it'll look exactly the same. So on 12/31, debit cash credit interest revenue, and it'll be the same amount, $37.50. So that's what the debt securities look like. Let's see. The next thing we have is equity securities. So we have two different methods for equity. It kind of depends which category it is in now. So the cost method, if we own less than 20% of the outstanding stock for that company, we use the cost method. So when I purchase the stock, so this would be for the trading and for the available for sale. So when I purchase the stock, sorry about that, looks a lot like the bond payment. So I debit, or the bond purchase, sorry. When I purchase the stock, I debit short-term investment trading, or the name might be long-term investment available for sale, or something like that. And so I debit that asset and I credit cash. Looks a lot like the bond there. When I receive a dividend payment, again, this is going to be the opposite of the guy who was paying the dividends in Chapter 13. So I will debit cash and I will credit dividend revenue. And then when I turn around and sell the stock, that's the disposition. And most of the times you're going to sell it for either a loss or gain. It's probably pretty unusual for you to sell it for the exact same price you got it for, as much as stock prices change. So you'll debit cash for however much cash you got when you sold it. You will credit the investment asset, so short-term investment trading or whatever it was called, for the amount that you put it in for. So let's say, let's just say up here you bought it for $100. And so it has to come out for what you put it in for. So because that's how much is in that account. So let's say you got, let's say you sold it for $90. Okay, so the difference would go on loss on disposal for 10. So this has to match this one down here, and then the cash is whatever you got for it. If it was a gain, that would be a credit instead of a debit. So debit the cash for whatever you got, credit the credit the investment, or again that could be long-term investment available for sale, for whatever you originally debited it for, and then the difference goes to your gain or your loss. So here's one of those. Maple invests $16,000 in Sprout stock. Then we got a dividend, and then we sell the stock on the 31st. And you can see right here that they're selling it for a gain. So let's do those journal entries. So I'm going to debit short-term. Oh, it was categorized as a trading, so they kind of have to tell you. Short-term investment trading for $16,000, and then I will credit cash for $16,000. Let's see, that was January 1st. Then on August 1st, I get a dividend payment, so I debit cash and credit dividend revenue for the $300 here. And then on the 31st, I'm going to sell the stock. So I'm going to debit cash, and they're telling me I sold it for $16,500, so I'll debit cash for $16,500. I will credit short-term investment trading for the $16,000. And then I have a gain. I need another $500 over here, so that'll be a credit to gain on disposal. And then it says, what was the net effect of this investment on their net income for the year? And so they got money twice, right? So you could figure out the total going in and out of cash, but basically they made $300 on the interest, on the dividend, and then they made $500 on the gain. So the total was an $800 increase to their net income. Okay, let's see. Now, if we own between 20 and 50%, so that means it is a significant interest in that category. We have to do things just a little bit differently. It's not too different, but the purchase and the disposition, those would look exactly the same. Purchase and disposition will be exactly the same journal entries as the cost method. Those don't look any different. We have two differences though. One of them is when the dividends are received. And basically what we're saying here is we're enough of an owner that we can't pay ourselves revenue. So revenue has to come from an outside source, and we're saying now that we own enough of this company that that's not really an outside source anymore, that's us. So instead of being treated as revenue, it's really being treated as kind of taking cash out of your own investment. So when you receive a dividend, you're still going to debit cash, but instead of crediting a revenue, you're going to credit that asset. So let's say long-term investment, and then the only difference, I said they're exactly the same, but really you put the company name. So it would be like long-term investment ABC company, if I have significant interest. So if we go back to this one, instead of these, significant interest will always be long-term, but instead of just putting the category, I actually put the name of the company in here. So like ABC company. So now I receive a dividend, I debit cash, but I credit the investment. And since that's an asset, I'm crediting it's going down. So it's kind of like I got cash, but the value of that investment went down because of the cash I took out in it. So it's kind of like an owner taking cash out is what it's like. The other thing is when, okay, let's say ABC is the company I invested in. When the ABC company declares a net income, or a net loss actually too, I'm enough of an owner that I get part of that, I get to declare part of that net income. It's not cash coming to me, but I still kind of get to count part of that revenue. So I debit long-term investment ABC company, and so the value of my investment goes up because of their net income. And then I credit revenue from investment. ABC. Oh no, I'd have to put the name of the company there. So I'm counting the revenue. The revenue is not going to cash though. The revenue is just going to my investment, making my investment worth more. And this would be for the amount. The amount of this will be for their net income times our percent of ownership. So if I own 25% of the company, I get to claim 25% of their revenue, their net income. Not their revenue, their net income. And I get to count that as my revenue. So as an example of this, we've got here, and again, these are all in the demo problem, so you can work on these if you, working on your own, make sure you got it. But so we're Staub, okay, and we decided to invest 11,700 shares of horse pasture stock when it's selling for $12 a share. August 1st, they pay a cash dividend to me, and then on December 31st, they report a net income of $60,000. So what type of investment is this for Staub? So there are 11,000. We have 11,700 shares, and there are a total of 26,000 shares outstanding, which means we own 45%. So that's significant interest, okay? Significant interest. Because we're in that 20 to 50% range. So the journal entries would look like, the first one would be when we bought the stock. So on January 1st, we debit long-term investment, and the name of the company is Horse Pasture, for, let's see, 11,700 shares times $12 a share gives us 140,400. 140,400, and then we credit cash because we paid that cash. Oops, 400. And then we receive a dividend on August 1st. So that'll be 11,700 shares times 30 cents a share. Means my cash dividend will be $35.10. So I debit cash, $35.10. But again, I don't count that as dividend revenue now. Since I'm using the equity method, I credit long-term investment. Investment Horse Pasture, $35.10. And then they declare net income, right? So their net income is $60,000, and I own 45% of them. So that means I get to claim a revenue of $27,000, and that will increase my investment asset. So on December 31st, again, if it's like an available for sale, if I have less than 20% and they declare net income, there's no journal entry for that one. I don't, that doesn't affect me at all. It's only if I'm using this equity method. Okay, so I debit long-term investment Horse Pasture for $27,000. I credit revenue from investment, $27,000. And then the last question says, in what category and at what value would Staub report the investment on the balance sheet? So we know that it's going to go into long-term assets, right? Because that's what this is. And then you have to say, okay, what's it worth? So we debited, and again, think of these as accounts, and the journal entry is telling me what you did to affect those accounts. So we started with a debit balance of 140. Sorry about that. I don't know what it's doing here. Oh, right over here. 140,400. And then we credited it $35.10. And then we debited it another $27,000. So a debit will add to it, a credit will decrease it. And so the ending balance then comes out to 163,890. So that's the amount that will get reported on the balance sheet for long-term assets. Let's see what I have left here. If I own more than 50%, really what happens then is we get into a whole other branch here. Then I become the parent company, and they become the subsidiary. And now we do what's called consolidated financial statements. Which really means their financial statements just get rolled up into mine, and it's not like their income and my income, and I take part of their income. All their revenues are my revenues, all their expenses are my expenses, their assets are my assets. So it's really just it's all combined now. So I think this is getting a little long, but I'm going to try and keep going because I really only have two more things to show you. One of them is this reporting at fair value. So this is if I'm doing trading or available for sale, and I'm using that cost method that we did. At the end of the year, you have to make an adjustment. So this is going to be an end of the year adjustment to market value. And we've seen how much the price of the stock changes, and so if I bought it for $12 a share, and now it's the end of the year and it's trading for $1 a share, then what's reporting on my balance sheet isn't accurate now at all. And so I have to make this fair value adjustment to bring it up to the market value. So if I, and again, it sort of matters which category it is. So if we're talking about trading securities, if I had a loss, if the value went down, the value of the stock goes down, then I have what's called an unrealized holding loss. And then I put the category trading. That means if I were to sell it right now, I would have a loss. And so I really have a loss, I just haven't realized it yet because I haven't sold it. But the value of it has still gone down. So I debit this unrealized holding loss. It's just a loss that I haven't physically had yet. But as soon as I sell it, I'm going to have that loss. And then I credit an account called Fair Value Adjustment Trading. And this is a contra asset account. Just like, and we've seen these kinds of things before. So when we did depreciation, you have the asset minus the accumulated depreciation, which is a contra account, gives you the actual value, the book value of that asset. Or when we did accounts receivable minus the allowance for bad debt, that's a contra asset. So the receivable minus what I think I'm not going to collect gives me the true value of that asset. So we've got the same thing here. We'll have the asset minus that will give me the true value. So if the value goes down, we have an unrealized holding loss. Or if the value goes up, I would debit fair value adjustment trading, and I would credit unrealized holding gain trading. And this unrealized loss or this unrealized gain gets reported on the income statement. Now, if it's an available for sale, the journal entries are the same. But it's not reported, that gain or loss is not reported on the income statement. Oops. It goes to an account called Accumulated Other Comprehensive Income, which is actually part of your equity. It does show up on something called a consolidated income statement. So you'd have your income statement, all your revenue and your expenses, the ones we are used to seeing in Accounting 1, and you would report your net income. And then if you're a company that has these, you would also have a consolidated income statement. It says, here's my income statement, and then there's maybe like 5 categories of weird little things, and this being one of them. That would so you would see, here's my income, my net income from my basic operations, and then you would add or subtract the gains or losses from these weird little things, and then that would give you your consolidated income. So it doesn't get reported in the income statement, but it does show up on this consolidated income statement. So do I have one of those? Oh, this is just a summary of those. Again, this is out of the book, so you can use this as kind of a little cheat sheet for where everybody goes and where it gets reported and what we count. But this one is, so I'm gonna, let's do this guy. So I have excess cash of $21,000, so I buy 1,400 shares of Hart Inc. stock at $15 a share. So that 2,100 there is the 1,400 shares times $15 a share. At the year end, the market price was $19, so I'm going to have to make, and this is a trading investment, so I'm going to have to make a fair value adjustment. So when I purchase the stock on February 1st, I am going to debit short-term investment trading, credit cash for the 2100. And then on December 31st, I need to make this fair value adjustment. So there's really two ways you could do this. Okay, we bought it for 21. Right now, it's 1,400 shares times $19. So it's now worth $26,600 minus the 2,100 that we paid for it means the adjustment we have to make is $5,600. The other way you could do is you could say, okay, it's now worth $19 a share. We paid $15 a share, so the difference is $4 a share times 1,400 shares. You get $5,600. So the difference, it's really just the difference between what you paid for it and what it's worth now. So we would debit, since this is a gain, we would debit fair value adjustment trading, and we would credit unrealized gain, unrealized holding gain trading for the $5,600. In what category and what value would the asset be reported on the 2006 or on December the 2016 balance sheet? And in what count would the market price? So the asset would be reported at its fair value. So reported at fair value, which is 26.6. So we report the new value, this one that we figured up right here. That's the $19 per share. So we report it at what it's worth now, and this is trading, so this would be a current asset. And then the change in price, the $5,600, is going to be reported in this unrealized holding gain is where that's going to show up. And what was the effect of the net income for the year? And that would be the gain. So net income will go up by, because of the gain, go up by $5,600, the amount of that. So that's that guy. And then this is an available for sale one. So we have excess cash of $41,800 by purchasing 2,200 shares. So again, 2,200 shares at $19 is the $41,800. And then we'll do a fair market value down to 15. So here we have a loss and available for sale because that's what they told us. So we'll see both of those. So when we buy the stock on June 1st, we debit short-term, they tell you it's short-term investment available for sale, and we credit cash for the $41,800. Now we have to make the adjustment on December 31st. So again, it's now worth 2,200 shares times $15 means it's now worth $33,000, and then we paid $41,800 for it. So we're going to recognize a loss of $8,800 is our loss. So we will debit unrealized holding loss available for sale, $8,800, and we will credit fair value adjustment available for sale, $8,800. And then at what category would it be reported on the balance sheet? So again, it would be a current asset, and it would be reported at its fair value of $3,300 or $33,000, right? That's this one, the $15 that it's worth now times the number of shares we have, and the $8,800 loss would show up in that unrealized holding loss. What is the effect of the net income? There would be none, because remember, since it's available for sale, this does not show up in the income statement. It would appear in that consolidated income statement, and it would bring, you take your net income and you would subtract that off. but it would not affect your net income. And then the last thing I just wanted to show you here very quickly was return on assets, because this is something that stockholders or potential stockholders look at a lot. So return on assets is calculated as your net income minus your interest expense divided by average total assets. And remember, when we say average, that's always your beginning assets plus your ending assets divided by 2 to get that average. And what this ratio measures is your success in using your assets to generate income. So what it kind of measures is not just, you might have a lot of investments, which might look good, but if they're not doing well, if they're not performing well, or even if your other assets, your operational assets aren't generating income for you, then they're not really being used effectively. And the last thing here, and I'll just let you look at this, but I have a link here to a General Motors balance sheet, so you can see that they have a lot of these things that I was talking about. And they also have it here where you can, so here's short-term investments that we talked about, bad debt accounts that we talked about last semester. We'll get to those different inventories here in a little bit. And then, what did I want to show you? Here's the long-term debt that we talked about last time. And some retained earnings, we talked about that. Here's that unrealized gain. So this would be, remember I said it showed up in the equity section. So this would be from their available for sale securities. There's a treasury stock that we talked about a couple chapters ago. So just so you can see, I'm not making this stuff up and it is real. Now also you could flip over here and look at their income statement. And this one is designed for, this website is designed for potential investors. So we have, you can view all these ratios. So some of these ratios that we've been talking about here kind of show that. But there's cost of goods sold, and this equity and affiliates, which is here, and it shows somewhere else too. That's that consolidated income statement that I was talking about. So they are a parent company to some other ones. So those revenues and expenses and stuff just kind of get lumped in over here. And this is a summary, but you can see that. And here's that consolidated net income that I was telling you about. So there, and then you pop over here to cash flow statements. That's what we'll be getting to in the next chapter. So if you can't wait till we get there, you can take a little look and see what we're getting to. So that's chapter 15. Sorry, that's a little longer than I planned, but there you go. Let me know if you have any questions.